We're all aware of what's happening in our world right now. Central banks around the world are printing money. Quantitative easing is artificially keeping U.S. interest rates low, and experts are warning about a bond bubble. Stocks have soared to all-time highs, but so has our national debt, ballooning to almost $17 trillion. What you may not be aware of is that all of these factors collectively could have a devastating effect on your retirement portfolio. Analysts are already predicting that these factors could have a crippling effect on the U.S. economy, putting many asset classes like stocks, bonds, and commodities at risk once again. As an investor, you may want to take a second look at your investment portfolio and diversify some of your assets. The vehicle we are about to show you, fractional life settlements, is the ideal way to diversify your portfolio as they are immune from the economic risks just mentioned. Over the course of the next 20 minutes, you'll gain a thorough understanding of what fractional life settlements are all about. Benjamin Franklin, one of the founding fathers of this great country we live in, couldn't have put it better. In this world, nothing can be said to be certain except death and taxes. Some of the oldest institutions in America are life insurance companies, who have been around for 150 years, and what they don't want seniors to know is that their life insurance policy contains a hidden asset. Reliant Life Shares and its investors have developed a way for seniors to capitalize on that asset. Let's take, for example, the Astors, a senior couple. The Astors own a $5 million policy issued by New York Life, a AA-rated carrier. The annual premiums are $200,000, and over the last 5 years, they have paid a total of $1 million in premiums. The Astors no longer need the policy and want to save the $200,000 they pay in annual premiums. Unfortunately for them, New York Life is only willing to pay the Astors $250,000, the policy's cash surrender, despite the fact that New York Life will never have to pay the death benefit claim, and the fact that the Astors have already paid them $1 million. As is usually the case, the Astors, through family or friends, learned of an alternative option, the life settlement option. After learning about the life settlement option, the Astors contacted their estate attorney, who informed them of the 1911 Supreme Court ruling in Grisby v. Russell, which ruled that your insurance policy is an asset you can sell just like a stock or bond. The Astors then obtained 3 competitive bids from buyers of life insurance policies, one of which was from Reliant Life Shares. Reliant Life Shares offered the Astors $1.25 million for their $5 million New York Life policy. The Astors accepted the offer and profited $1 million more than the minimal cash surrender offered by New York Life. From their $1 million profit, the Astors set up college trust funds for their grandchildren and took a cruise vacation to Europe with a small portion of the proceeds. As you can see, the life settlement option provided the Astors with $1 million more than the cash surrender amount that New York Life was offering. By choosing the life settlement option, the Astors benefited 400% more than they would have had they accepted the $250,000 cash surrender option. This is not an isolated condition. In fact, the Wharton School at the University of Pennsylvania conducted a landmark study for the life settlement industry in 2002, whereby they examined a total of 1,584 life insurance policies. What they found was astounding. They discovered that the average cash surrender values totaled just over $93 million, whereas the average life settlement options totaled just over $336 million. This represents a shocking 360% difference. As you can see from the study, had those 1,584 policyholders chosen the life settlement option, they would have profited $240 million more than the cash surrender option. Now that you see how life settlements protect seniors, let's talk about the birth and establishment of the life settlement industry. What you see here is a historical timeline. As mentioned before, back in 1911, the Supreme Court in a precedent case, Grisby v. Russell, ruled that life insurance policies are an asset, which can be sold just like a stock or bond. In the 1980s, the AIDS epidemic left many patients in need of money for treatment. A trend emerged whereby those patients could sell their existing life insurance policies for more money than the life insurance companies were willing to pay them in surrender value. These transactions became known as viatical settlements, and the secondary market for life insurance policies was born. In 1995, recognizing the need for industry regulation and professional standards, the Life Insurance Settlement Association, LISA, was formed to promote the development, integrity, and reputation of the industry. By 2001, the phrase life settlements was born as seniors discovered a new option to exit unneeded life insurance policies. Seniors could now sell their policies as life settlements, a lucrative alternative to policy lapse or cash surrender. By 2005, life settlements quickly grew to a $10 billion industry. At this time, the market was regulated in 2/3 of all states and provided seniors 3 to 4 times more value than the cash surrender option. However, many policy owners were still unfamiliar with this market. Today, life settlements are a $16 billion market, and the industry continues to grow at a rapid pace. Institutional investors dominate the marketplace, while more and more states regulate life settlements. Senior awareness still remains limited, though. As you can see, the Life Settlement Association of America notes, in the last 4 years, life settlements have provided over $8 billion in additional value to seniors in America. Lisa also notes that this industry not only benefits the seniors, but the country as well. The industry is highly regulated, creates additional tax revenue to the U.S. Treasury, and employs a sophisticated workforce of thousands of people. Because of the increased legislation, this has opened up the life settlement market. Because institutional investors recognize the value of this asset class, the life settlement market has developed into an almost $20 billion market and is expected to hit $50 billion over the next 6 years. In fact, Businessweek, in their 2007 cover story, noted early investors included the major hedge funds and, more importantly, Wall Street banks such as Goldman Sachs, Credit Suisse, and Wells Fargo. These institutional investors have profited from life settlements since the beginning. Why did so many institutional investors invest billions of dollars into this market? Well, that question was answered during one of the worst financial crises this country has experienced since the Great Depression of 1932. During the financial crisis of 2007 through 2009, the Dow Jones Industrial fell 6 months in a row to 50% off its record highs hit in October of 2007, and the S&P 500 was 53% off its October 2007 peak. In fact, the Wall Street Journal noted in its March 1, 2009 article entitled "Brutal February for Blue Chips," the S&P is off 53% from its October 2007 peak and has now seen its worst 6-month drop in percentage terms, 42.7%, since 1932, when it dropped 45.4% in the 6 months ending in June. With that said, please note that this is one of the most important parts of the presentation. Here we have empirical data which demonstrates the potential of investing in fractional life settlements. Regent Asset Management Limited is one of many funds investing in life settlements and provides an excellent example of a fund that profited in this asset class through the 2007 through 2009 financial crisis. If you look at the chart on the left, pay attention to 2007, where the light purple line, which represents the S&P 500, begins to nosedive. The S&P loses more than 50% of its value by 2009. Again, the worst drop since the 1932 Great Depression. Similarly, the 10-year government bond, the green line, is fluctuating erratically, and like the S&P 500, was affected from the 2007 to 2009 financial crisis. The Life Settlement Fund, on the other hand, the blue line, maintained a steady growth, and not only outperformed the S&P 500, but the U.S. government 10-year bond as well. What is important to note here is that the Life Settlement Fund earned double-digit returns during this financial crisis, and that is because life settlements have no correlation to the stock or bond markets or other economic factors for that matter. They are, in fact, immune to them. As we've learned so far, institutional investors dominated the life settlement space. Now, through Reliant Life Shares, individual investors can participate in the profitability of this market just like institutional investors have done for over a decade. This is only available, however, to California investors. California has what is called a first-mover advantage, which is an advantage gained by the initial, first-moving, significant occupant of a market segment. For example, eBay, a California company, had the first-mover advantage in online auctions and profited billions of dollars from that. California is not only the first state, but the only state that addressed individual investing in life settlements in their legislation through Senate Bill 1837, which now allows individual investors to invest in fractional life settlements. While many states have legislation that protects a senior's right to sell their policy, and in fact many states now require life insurance companies to inform seniors of that option, California, through Senate Bill 1837, regulates the life settlement industry for investors. Christiana Trust is Reliant Life Shares' third-party escrow agent and trustee. Christiana Trust is a division of Wilmington Savings Fund Society, a Delaware institution founded in 1832 and one of the 10 oldest continually operating banks in the United States. WSFS Financial Corporation is a $3.8 billion financial services company. The NASDAQ trading symbol is WSFS. Reliant Life Shares appointed Christiana Trust as third-party escrow agent and trustee because of their 30 years combined experience in life settlements, as well as the fact that they are a division of a large institutional bank. As authorized by Reliant Life Shares, Christiana Trust acts as an escrow agent and accepts the investor's funds into the subscription escrow account until the investor selects their desired policy. The flexibility of this account allows investors to withdraw their money anytime without a penalty. Investors who place their funds in the subscription escrow account have the unique advantage of participating in Reliant Life Shares' most desirable policies before they become available to the general investor pool. After the investor selects their policy, Christiana Trust will transfer their subscription funds from the subscription escrow account to secure their purchase and fund the premium reserve account, which is administered by Christiana Trust. Christiana Trust confirms that all required premiums are paid from the premium reserve account. Investors will be informed upon the maturity of any life insurance policy as required. As a further measure of checks and balances, Christiana Trust is the only signer of all accounts, and Reliant Life Shares has no access to them whatsoever. Once a policy matures, Christiana Trust files the death benefit claim, and the investors receive their proportional share of the death benefit as predetermined in their purchase agreement. The investors then have two options. First, the disbursement option. Investors can receive all or part of the maturity value, or, second, the reinvestment option, which is what most investors choose. Investors can reinvest their maturity value by selecting from the current portfolio of available policies. In addition to the blue-chip expertise of Christiana Trust, let's examine the life expectancy providers. Life expectancies are derived from a thorough examination of an insured's medical history and government actuary tables, and are perhaps the most significant component to this investment. As we mentioned during the opening of this presentation, two things are certain in this world: death and taxes. The variable is, when will a policy mature? Because that variable is so important, Reliant Life Shares utilizes the same life expectancy providers that institutional investors have utilized for over a decade. In fact, a recent study from one of these providers confirmed a 96% actual to expected accuracy based on 3 successive independent actuarial studies. Now here's an example of an actual AVS life expectancy report. As you can see, it provides pertinent information about the insured. The insured is an 84-year-old male born on November 10, 1926. AVS calculates his life expectancy to be 67 months, or 5.7 years. On the bottom portion, you will find a detailed medical description. Each investor will get a copy of these reports on every policy they're considering investing in, with the insured's name redacted. Each time we present a policy for investment consideration, we provide the investor with a Reliant LifeShares case summary. The case summary is divided into 3 sections. First is the carrier's information, second is the insured's information, and finally, the premium payment information and the investor's fixed return. So let's start with the carrier's information. This provides information on the insurance carrier who issued the policy for investment consideration. As you can see in this example, this policy was issued by New York Life, a AA-rated carrier, on April 5, 2008, and the death benefit is $5 million. The annual premiums on this universal life policy are $175,000 and are due annually on April 7th. Now let's look at the insured's information, which shows the investor pertinent information about the insured: their age, date of birth, gender, both life expectancies, as well as a detailed medical description, which is taken straight from the life expectancy reports. Finally, the last section shows premiums escrowed and the investor's fixed return. As you can see, for this $5 million policy, Christiana Trust will transfer $875,000 from the subscription escrow account into the premium reserve account. The second part of this section shows the investor their total fixed return up front on the amount of money they will receive upon a policy's maturity. In this case, an investment of $50,000 will mature into $85,000 in 5 years, which is a 14% annual return. Let's take a look at a Reliant LifeShares annual return, which provides a detailed breakdown of an investor's total fixed return. In this case, we have a policy with an average life expectancy of 5 years. If you look at row 5, a $50,000 investment will mature into $85,000, which represents an annual return of 14%, assuming the policy matures in year 5, as represented in the average life expectancies. Now, let's assume the policy matures in the second year. If you look at row 2, the $50,000 will still mature into $85,000, but the annual return is 35% instead of 14% because of the early maturity. Moreover, because only 2 of the 5 years of escrowed premiums were used, each investor receives a refund of their proportionate share of escrowed premiums. In this case, the investor would receive a refund of $24,000. So now, the investor's $50,000 investment matures into $109,000, which is a 59% annual return. Now let's assume the policy matures in year 7. In that case, 2 years of premium calls in the amount of $8,000 would be necessary. The effect is the investor's $50,000 would now mature into $69,000, which is still a 5.4% return and much better than a CD would offer. It is important to note here that we generally buy policies on 80-plus-year-olds with chronic or significant health conditions which reduce their life expectancies. So in this example, a 7-year life expectancy would be unlikely, given this 80-year-old's chronic health condition. Once an investor is ready to invest, they will receive multiple case summaries showing them what policies are available. As we already discussed, every policy will have a case summary showing the carrier information, the insured's information, as well as the premiums escrowed and their fixed return. Once the investor chooses their desired policies, they complete the Investor Suitability Questionnaire, which ensures this investment is suitable for them as required by California law. They then review and execute the purchase agreement, which details the premiums escrowed and their fixed return. Once the documents have been executed, Christiana Trust will issue the beneficiary interests in the policy or policies chosen by the investor. One of the best attributes of this investment is that it can qualify for IRA and 401k rollovers. We use Entrust IRA Services, the largest self-directed IRA custodian in the U.S. for our IRA accounts. Upon opening an account with Entrust, the investor will simply roll over or transfer funds from their existing retirement account into the new Entrust IRA. Once funds are received, the investment is then placed with the investor's Entrust IRA account, which then owns the investment for their benefit. So, in summary, we learned that the life settlement option is good for seniors and provides them 3 to 4 times more money than they would receive from the carrier's cash surrender option. We also saw that while life settlements were originally designed for institutional investors, the profitability of the life settlement market is now available to individual investors in California through Reliant Life Shares. In addition, we observed that life settlements survived one of the harshest economic litmus tests this country has experienced. They outperformed the S&P 500 and even the 10-year government bond, while exhibiting lower volatility and earning double-digit returns. As we mentioned in the beginning of this presentation, current world events such as the crisis in the Middle East and this country's looming trillion-dollar deficit are predicted to have a crippling effect on the U.S. economy, putting the U.S. bond, the S&P 500, and the Dow all at risk once again. As an investor, you may want to take a second look at your investment portfolio and diversify some of your assets. As we just learned, investing in fractional life settlements is an excellent vehicle to truly diversify your portfolio. For those of you who would like to learn more or preview the current policies we have in inventory, please contact the person who directed you to this video, and they will be happy to assist you.